Next up is Nick Axford, Principal and Chief Economist for Avis & Young. Nick has over 30 years experience in real estate research and consulting in the private sector, having led teams in the UK, European, Asia Pacific, and global levels. Based in London, Nick is responsible for Avis & Young's global market analysis and thought leadership activities. This morning, Nick will provide our thoughts on the year ahead and the market trends that will help shape investment and occupancy strategies in 2023. Welcome, Nick Axford.
Great, thank you. Thank you very much indeed, Jeff, and good morning, everybody from here in London. I'm going to do a quick run through the publication that we've just launched, 10 Trends for 2023, came out earlier this week, focusing on a few things, some mainstream, some less so, that we think are going to influence the real estate market in 2023 and quite probably beyond. So let's just do a quick run through. I haven't got time to go into all 10 in detail. So let's have a quick run through. And I'm going to start with number 2. We'll leave number 1 because I'm going to come back to that. So number 2 is operational excellence. And as you've heard, that's about the real increased focus on management and operationally really understanding what's going on inside buildings, including in mainstream sectors, the office sector, following retail down the path of the drive for experience, but also how investors are increasingly targeted other more niche sectors where really understanding what's going on under the hood of the building from an occupier point of view is really, really important. That links to our third trend, which we call doctor's orders, which digs in a bit more detail along those lines to look at the opportunities in the healthcare sector, where demand has increased quite significantly due to a variety of societal trends, but particularly accelerated by the pandemic, and where we're using advanced data analytics to really help operators and investors understand what's going on in the sector and where the opportunities might lie. Trend 4, deglobalization 3.0. It's a topic that we've covered several times in the past. And this time what we're really focusing on is how the ongoing changes in locations of production and supply chains are still being influenced by the trend towards deglobalization, and particularly the rise of the conflict in Ukraine, giving an accelerated emphasis on what's becoming termed friendshoring, which is actually still continuing to reshape the landscape for production and logistics. Changing focus, trend number 5, picks up on a core ESG theme, the environment and sustainability. And we call it critical mass because it's looking at the growth of mass timber actually as a structural component for the construction of commercial real estate buildings. It's becoming more prominent. The buildings that it's being used in are getting taller. And we see this as a trend that in many markets is going to become more prominent over the years and an aspect that people ought to start getting familiar with. Similarly, within the ESG space and the environment, trend 6, new lease of life. This focuses on the trend that we see for green leases and green lease clauses, which have been around for quite a while, to become more prominent in leases going forward. That's because both market pressures, but particularly regulations, are requiring an increased emphasis on data and understanding the environmental performance of buildings and disclosure of those buildings. That's putting obligations on both landlords and occupiers, and those are going to need to be incorporated into lease agreements to make clear who needs to do what, when, and why. Trend number 7, cities revitalized, picks up on a theme that we've already heard a bit about in terms of the way in which cities are coming back to life, but they're not coming back the same as they were. And as Dina was talking about, we talk about how our Avant analytics platform and particularly our Vitality Index helps understand the patterns that we see as different cities start to recover. And particularly, we dig into the issue that was referred to about flight to quality and the fact that we see a big bifurcation in the office market coming, with better quality, better located space performing very differently to some of the more secondary space that could suffer quite significantly. Returning to the ESG theme with trend number 8, maximum impact, we pick up on some of the challenges that are certainly being faced by our inner city areas and urban areas, which really require investment and regeneration. And we see a coming together of the private sector and the public sector in partnership, with the private sector with an increasing focus on social value in the developments and investments that they're undertaking. And that can be a big stimulus and catalyst to helping revitalise impact investing and the regeneration of many of our cities. Slightly linked to that, trend number 9, cost of living, focuses on the opportunity in the affordable housing sector. In many countries around the world, we have what amounts to a housing crisis, particularly at the affordable level. And although it can be challenging to make that financially viable, we see an increasing range of incentives coming available that will help bridge the gap. And we particularly think it's worth looking into a sector where the underlying demand drivers are strong, because there is almost limitless demand for this space. And trend number 10, we take a look at the metaverse, which hasn't probably had the best of presses in recent months, but we think that focusing on some of the challenges of Bitcoin or whether people are really going to live out their lives in Decentraland actually misses some of the really important ways that the technology that underpins Web 3.0 and the metaverse is actually already having an impact on the real estate market. So that's 9 of the trends. The 10th one, we've called higher for longer, and I'm going to spend a few minutes just digging into that, because I think it hits to the turmoil that was referred to in the capital markets. Because as I'm sure you're aware, the key issue that we've been facing in recent years is that after 40 years of low inflation since the hyperinflation of the 70s, we've seen an extended period of low and relatively stable inflation, which has obviously not been the case over the last couple of years, that we've seen inflation spiking very rapidly, not just in North America and in the US, but really right the way around, certainly the Western world. To an extent that was completely unprecedented, the speed with which inflation has picked up. Now, the good news is that in most places, we think that inflation has turned the corner. Certainly here in the US, we've now seen several months of weakening, not just headline inflation, but core inflation starting to decline as well. And we do think that we're now sort of at the turning point. We are going to see inflation trending downwards from here on in, although it won't necessarily be a uniformly smooth, plain sailing process. But of course, it's going to happen in a context against which we've seen central banks in their desperation to tackle inflation and prevent a wage price spiral. We've seen central banks around the world hiking policy rates very, very dramatically and very aggressively, almost certainly at the fastest rate that we've seen since the 1970s and 1980s. We're not at the peak yet, but as the announcements and comments that have been made by the Fed yesterday, the Bank of Canada last week, and the Bank of England today, we are now starting to see, we think, light at the end of the tunnel, and we're getting close to the peak. We're not quite there yet, but we're getting quite close to the peak. I think the key message that I want to get across, and I'm sure Greg will have some comments on this as well, is that whilst inflation might be turning the corner, and whilst there may well be discussion about whether or not the Fed's going to start plateauing for most this year, and then could even be cutting rates by the end of the year, personally, I think inflation could stay a bit stickier than people think, and that we might be lucky to see any cuts by the end of the year. I'm not sure necessarily when we get a 25 or 50 basis point reduction is the point. The point is far more that we believe that we are very unlikely to go back to anything like the sort of level of interest rates that we saw in not just the pandemic period, but in most of the post-financial crisis period. And that's really important for the financial markets, and it's really important for real estate, because the corollary of that low level of stable inflation over the last 30 or 40 years has been this long-run downward trend in not just policy rates, but in market interest rates, in the 10-year government bond yields around the world. This has been a huge following wind for real estate and lots of other investment markets, as this is the benchmark against which pretty much every other kind of investment asset is priced. And what's really interesting is, to look at it's the speed of the correction that is catching everybody out, and the very, very low level of interest rates and benchmark yields that we're coming from. It's perfectly possible. We're not going in, we're not in some unusual blip period which is going to correct very quickly. We're actually, we believe, going back to a much more normal interest rate environment. And that means that the type of correction that we're seeing in pricing, we need to think of as actually a return to something more normal rather than a blip that's going to automatically correct. Now, real estate doesn't directly follow what goes on in the 10-year government bond yield market. An interesting comparison is with the 10-year BBB corporate bond market, which builds in the risk of tenant default. And here you can see the close relationship between real estate yields, real estate cap rates, and the 10-year BBB, excuse me, which is even stronger if we allow for the time lag that feeds through in the market. It takes time for real estate to respond. You can see there's a very strong correlation there. So if we're thinking about what real estate pricing looks like, you can see that the real estate cap rate is effectively made up of three components. There's that risk-free rate, the 10-year government bond, the risk of corporate credit default, which is the BBB spread, and then the orange bit is the bit that's directly attributed to real estate. Now, this is annual data and there are leads and lags, but we can see some interesting patterns if we just take some summaries from the pre and post GFC period, stripping out the periods of real turmoil. You can see that in the run up to the financial crisis, real estate was based off somewhere around 500 basis points of risk-free, 200 basis points of corporate risk, and then 75 basis points or so of real estate. In the period up to the pandemic, the big difference was the fact that those risk-free rates, those 10-year government bond yields were significantly lower. And so we can use these relationships and the fact that there is typically around a 12-month lag between what goes on in those financial markets and what goes on in real estate to sort of project forward what the financial markets are currently telling us and giving us a sort of direction of travel for what's going to happen in real estate. Now, the yield data here is still a little bit dated. We're still waiting for data to come through for the latter part of the year. But what you can see is that quite clearly that the whole pricing environment for real estate has changed very, very dramatically. And I'll come back and look at where that might be going in a second. But the other thing that's really interesting is that real estate pricing isn't just related to the BBB. It's quite interesting if we look at those BBB corporate bond yields and the relationship with investment transaction volumes. This is average rolling 6-month transaction volumes. You can see there's a very strong negative correlation, so that when those bond yields go up very sharply, repricing tends to happen. The first thing that happens is the market stops. People wait and see what's going to happen. The bid-ask spread widens, and therefore you can see very clearly how the immediate impact of that increasing bond yield and change in pricing has been a dramatic decline in the volume of transactions that we're seeing in the market, albeit that, you know, the level of transactions, even though it might feel a lot slower than it was, you know, is still actually at what historically has been quite a high level. And if we just dig into the sectors, here what we do is look at the volumes in each of the sectors. And what we've done is compared them to the average that we saw during the period from 2015 to 19 pre-pandemic, which was actually relatively stable in terms of the volume of activity. And what we've also done is just seasonally adjust it. So at any point, what you're comparing is the transactions in the last 3 months compared with the equivalent average 3 months during 2015 to 19. So it takes account of the seasonality of the market. What you can see is that in 2021 and 2022, we had a really active market as we came out of the pandemic, but that has really slowed very, very dramatically over the course of recent years. I mean, in the apartment and industrial markets, the transactions we've seen still pretty much in line with what we were seeing in 2015 to 19, but falling off in the retail and office market. And just digging into the office market in a little bit more detail, also interesting that there are some nuances there. You know, this is on the same basis. What you can see is that there was a recovery in office transactions across the US to above the 2015 and 19 averages during up to the early part of 2022. But since then, there's been a decline. And particularly, even though suburban office transactions are now 40% below what we would normally expect at this time of year, Actually, CBD office transactions are 80% below those averages, and in fact back down to the sort of levels that we were seeing at the height of the pandemic. So clearly we are at the point at the moment where there is still price discovery to happen in order to get the market moving again. To finish, where do we think we're going? Well, on the left, you've seen those two bars before. Where do things stand at the moment? Well, at the moment, the 10-year government bond is up at around 3.4%. The BBB spread around 200 basis points, roughly where we would expect it to be. Real estate hasn't yet corrected. If we look forward, we would expect, given that we don't expect interest rates to come back down very significantly over the next few years, we would expect the 10-year government bond to benchmark probably somewhere just north of 3%, which is significantly higher than we've been used to in recent years. The corporate spread, I don't think there's any particular reason to expect that to expand. But depending on where you are in the real estate market, I've put on a 50 basis point risk premium here for real estate. That could be a bit cautious, particularly in parts of the office market where I think people are seeing more risk associated with real estate now than there has been. So what that suggests is that if those benchmark quality real estate yields, cap rates are currently around 4.8%, it suggests that there is still a material way to move before we start seeing pricing coming back into line with where we think the equilibrium point is relative to other assets. So correction to come. The more we get pricing discovery, which hopefully will come as we start seeing potentially some distressed sales or liquidity coming back, investors seeing a bit more comfort around what they think the interest rate outlook looks like, being able to price deals again, starting to then put their plans in place. So hopefully a return to a more active transaction market as we come through the latter part of, potentially the latter part of the first half, but more likely into the second half of 2023. So there we go, a very quick canter through our 10 trends for 2023. With that, I will try